Now that you have your business plan completed, your next step is most probably to raise money for your new startup business. And in this video, I'm going to explain the most common methods of raising finance for startups. Now, assuming you have a great business plan, it is my personal view that it is not that hard to raise finance. And this is because there are many government departments as well as private investors who are in the business of lending money. And all that you have to do is to make sure that you meet their requirements and you should be successful in raising money. I'll display a list of South African government websites specializing in finance startups. Many of them have mentoring programs which are extremely helpful, guiding you through the process. So don't forget that raising finance is actually a double-edged sword. And what I mean by this is, on the one hand, you may benefit from that immediate cash injection to start your business, while on the other hand, you have to give something back to the lender. And this may be in the form of either giving away some of your ownership, or interest and capital repayments, or sometimes a combination of the two. Here's the crazy thing. Most traditional lenders like banks and venture capitalists don't want to finance startup businesses. And this is because the business startups have no track record, no clients, and most probably no cash flow. These traditional lenders are only interested in you once your business is established. But the good news is that the loan terms for these traditional lenders are usually more favorable, as the risk of failure has been reduced. So where does this leave you? If you are fortunate enough to have built up some of your savings, you should use a certain percentage, an amount that you are prepared to risk, as your startup capital. Remember, it's much easier to find an investor if you show that you have invested your own money into the business. Most people tend to first ask friends and family, as it seems easier, because they already know you and if they believe in you enough, they will lend you the money without having to know if your business idea really works. In South Africa, we have a peer-to-peer lending system called a stokvel, which is an invitation-only club of, say, 12 or more people, serving on a rotational credit union, where the membership contribution of fixed sums to a central fund on a weekly, fortnightly or monthly basis. This method of lending is very popular and has been around for a long time. But you should be aware, when borrowing money from friends and family, your relationship is also at stake. So it is a prudent idea to draw up a contract to eliminate any misunderstanding at a later stage, should the venture not work out. For me, a new and exciting option is actually crowdfunding. And this is where the power of the internet can be harnessed to find lots of people who invest small amounts of money in your company. One of the best things about crowdfunding is that it generates interest by marketing the product alongside the financing. It also cuts out any brokers by putting the funding in the hands of the common person. At the time of making this video, crowdfunding in South Africa was not being regulated. One can also consider microloans, but I've always been a bit skeptical of this option, as the interest rates are usually very high, and the industry has not had a good reputation due to the exploitative nature. The maximum amount a lender can charge for an unsecured loan in South Africa is 31%. Besides the previous methods of financing, you could also consider some sophisticated methods such as vendor finance, purchase order finance, or factoring. Let me explain briefly. Vendor finance is if you are reselling somebody else's manufactured product and you can convince them to defer the payments until you yourself have sold it. And this is also known as selling by consignment, which in effect is just an extension of the normal 30-day terms. Purchase order financing is a short-term finance option offered by financial institutions to pay suppliers upfront so that you can benefit from bulk purchases. Factoring is exactly the same as a purchase order financing, except it pays you all your unpaid debtors immediately, but at a discounted rate. And this should supply you with immediate cash flow benefits instead of waiting for the normal 30 to 60 days. I would suggest that you study these various finance options available to you before approaching a financial institution. And once you have an idea of the terms and the interest rates charged and so on, then put that information into your business plan. And that would immediately show you the viability and the costs of the loan over the payback period. Here's the irony. It is easier to get a 5 million rand loan approved than a 50,000 rand one, but it's harder to pay back the bigger loan. So the key is to get the size of the loan correct. Repayments must be affordable. From the financial institution's perspective, it is the same amount of effort and red tape that goes into a loan application. So they would prefer the larger loans, as they have targets to achieve in terms of lending out money. Remember to study the benefits and drawbacks of each financial option and select the one that will help you meet your business goals. I hope this introductory video series has been helpful to you. So until next time, remember, we are here to help.